In this video, I will discuss the concept of operating leverage. Operating leverage is a measure of a company's relationship between the variable cost and fixed cost. And the reason it's practical for us is that it's an indicator of how sensitive profit will change with changes in sales. So as a general concept here, a company with a low operating leverage is said to have high variable costs relative to fixed cost. So this type of company would have a low break-even point. And we would say that such a company with a low operating leverage would not suffer severe changes in profit with respect to a change in sales. So changes in profit are not as sensitive to changes in sales relative to a high operating leverage company. So high operating leverage company would be one with low variable cost but a very high fixed cost level. This type of company would have a high break-even point, and changes in profit would be more sensitive with respect to changes in sales. So a common measure used to describe this concept of operating leverage is the degree of operating leverage. The calculation for the degree of operating leverage is as follows. But before, let me explain the margin of safety concept, which is a part of the function. Margin of safety is the excess of sales over break-even point, over break-even sales. So it's sort of those extra units that we're selling above break-even point. We can derive the margin of safety percentage by estimating the margin of safety divided by sales. In which case, then we can compute the degree of operating leverage as follows. Degree of operating leverage is either the contribution margin divided by net income, or 1 divided by the margin of safety percentage. Here's an example of how we use this. So for example, assume a company has total fixed costs of $316,000, contribution margin per unit of $2.88, and current sales volume of 125,000 units. Their break-even point from the general break-even function gives us 316,000 divided by 288, or 109,931 units. So to break even, they need to sell roughly 110,000 units. Currently, they're selling 125, so their margin of safety is the excess, or 15,000 units roughly. I can compute the degree of operating leverage using this information. The degree of operating leverage would be 1 divided by the margin of safety percentage. And here I compute the margin of safety percentage as follows. This is the number of units in excess of break-even point divided by current sales. So that margin of safety percentage is 12% roughly. The degree of operating leverage is 1 divided by the margin of safety percentage, or 8.3 roughly. And what this means is that any percentage change in sales will affect net income by 8.3 times that change in sales. Here's a quick illustration. Assume that sales were to go up by 30%. So that's a change of 30%. We can say that profit will change by 248%, or 249% roughly, which is the degree of operating leverage times that 30% that we're describing here. So this is what the current income statement might look like. Assume that they sell the product for $7.20 and that the variable cost is $4.32. So their current income statement might have a contribution margin of $360 based on current sales, and then fixed costs being subtracted here give you $43,400. If we allow sales to go up by 30%, which is this 1.3 right here, times sales price and variable costs, we would come up with a net income of $151,400. That change in profit, if you were to compute it, 151 minus 43.4 divided by the original amount is 249%, as the degree of operating leverage would have indicated. And here I just illustrate how sales went up 30%. So that's how we can use the degree of operating leverage. If we know a change in sales, then we can compute a change in net income.